In part 2 of this video, we're going to really accomplish two things. First thing we want to talk about is a completion of this concept of how we find value, of how we use predictions of the future and put them together in a formula sense to quantify where we think stock prices will go in the future. In addition, then we'll start with the actual more technical valuation techniques to identify specifically how we might do this for some companies. So, continuing with our example, we may want to ultimately estimate what we think dividends will be in the future. So, estimated earnings per share multiplied by the dividend to payout ratio give us an idea of what we expect the dividends to be paid. Again, all of this data that we're gathering through this forecasting piece will ultimately be used in a technique, if you will, to identify what we think the value of the company will be. So ultimately, the price, the ending price, is the estimated earnings per share multiplied by the estimated PE ratio. So we need this estimated price because obviously it pulls everything together, right? It is our vision of what we think will happen to the price. What is the company's value moving forward? So we're going to use some forecasting from Disney. Let me get rid of this here because it's Disney. We're going to go through a sequence. Right? We're going to understand or take a look at what the company provides us historically in the form of dividends or information in general, and then work our way through to our projection of share price. So let's think about the data that we need to know about Disney. We need to know something about total assets. TAT is total asset turnover ratio. This is an efficiency ratio. We need to understand something about net sales, sales growth. Now, what this data represents is the history from 2012 to 2016 of information that was gathered either from calculation of ratios or through actual financial statement line items, and then their averages, right? So again, we have net profit margin, dividend payout, the PE ratio per year, and then obviously the outstanding number of shares per year. Now, one of the things we need to keep in mind, as been mentioned earlier, is the direction, right? What does the trend look like? And of course, you can see here that it appears that the company is growing in size, right? So it has an increase in size every year. But we also look down below and we see that in general, it appears that the number of shares is declining. So when we incorporate these numbers into our technique, we need to keep in mind what the trend tells us, right? I mean, if you look at sales growth, 6.5, 8.3, 7.4, 6, I mean, 7% seems to be a reasonable adjustment. We don't seem to have a lot of up or down, although there's been a little bit of a trend downward, right? So 7.11 probably sounds like a reasonable, unless I know something else about what's going on in the company, seems like a reasonable estimate, if you will, of the future. So again, this is always up to the discretion of the analyst, right? You know information about the company because you're really exploring it. You're getting into the details. This gives you a way to really adjust some of the numbers to reflect your knowledge. So here we have this first column here is just, it's either the average number we had from the previous page or it's the actual last number. So the sales growth rate was 7.11%. And net sales the last year was 55,632. So we project moving forward for the next 3 years, given a 7% growth rate, what will sales be over the next 3 years? The net profit margin was the average from the previous slide. Plug that in then into this formula, right? So it's net profit times sales gives you net income. Common shares, we had 1,639 was the last number. Now we do remember from the last slide, this number has been going down. So should we use this number or should we adjust it downward maybe even a little bit more? That's up to the analyst, of course. I kept it the same just to make life a little easier. So net income divided by shares is earnings per share. Here's the payout ratio, 24%. So we estimate our dividends per share, $1.40, $1.50, $1.60 moving forward. Earnings per share, 5.29. That's obviously what? The earnings per share is this line item from up above. Multiply that times the PE ratio that we forecast, or that we've, in this case, maybe using an average. So here's what we think the share price will be moving forward. And regardless of what the numbers are, apparently it looks like we're going to be seeing increases in stock price moving forward. So this might be an indication, again, that maybe the value will increase over time. Again, this is just a technique. We want to apply many techniques to our issues and our challenges with valuing assets. So again, this process is a process to determine the worth of an asset. We have to identify cash flows. We need to understand when we think they're going to come. We need to have an idea about the risk of the company. And again, a stock will be worthwhile if the expected return equals or exceeds the return we feel is warranted, right? The justified intrinsic value, right? The justified price. If that is equal to or greater than the current price, we would want to buy this investment. And again, just to harp on it, we know that there's no assurance that the real thing is going to be exactly what we project, right? Projections of themselves have errors involved. So let's start the process thinking about required return. We've talked about the security market line in an earlier chapter, an earlier video. So we know what the beta here, this beta is, can get that from online sources and print sources. The risk-free rate of return is the current return by a risk-free investment. Now, your textbook talks about it could be a treasury bill or treasury bond. My personal idea or thoughts on this is it should really be a treasury bond to reflect the kinds of inflation that affects stocks over the long haul, right? Treasury bills have less than a year in life, so their basic inflation premium, if you will, is very, very small. And stocks and bonds obviously have longer lifespans. The market, obviously, we can use some estimated long-run average from the stock market. So all those things we've talked about in the past. But this is a very quick and easy formula with data that's readily available that can give us a picture of what we would require of a company. So if a company had a beta of 1.3, risk-free rates 5.5, and the stock market return is 15%, what's the required rate of return for this investment? Again, we can use this portfolio beta and return worksheet to solve for this. And there are other places where you'll be able to use this, but this is the easiest place to find it. And you plug the numbers in. For this company, you would expect to get a 17.85% rate of return on this investment. If you thought you were going to get a 15% investment, you would not want to buy this because 15 is not enough. You want more because it is riskier. So moving forward, so if we think about this, how do we apply all this stuff? How's this stuff fit into our techniques? We're going to talk about a couple of different techniques or models. We'll start off with the dividend valuation model, and then I'll work our way into some more multiplier models as we go through. So the dividend valuation model basically has three approaches or three versions. There's a zero growth model and a constant growth model, a variable growth model. For just to save time, and because in the end it really doesn't matter, I assumed that the zero growth model was just a specific version of the constant growth model. If your stock never grows, we would say that it has a constant growth of 0. So we really only need one formula. We only need one model. Now the variable growth model we'll talk about later in another video basically assumes that this company is different, that it has some time periods where it may grow at faster or slower rates, and there's a reason for that we can predict, if you will. So the basic idea of the dividend valuation model is that it's a very simple formula. You take next year's dividend, divide it by the required return for the stock and the growth rate of the dividends of the stock that you think are going to come in the future, or their future growth rate of dividends. To find next year's dividend, we know this one. We know D0. We've already talked about this. You know how to calculate the required return. These two variables are known to us. The variable that we don't know is G. It's the growth rate. So that's the one we need to concentrate on. This works very well with large companies, mature kinds of companies that have established dividend policies. But if a company doesn't pay a dividend, or if it's erratic in paying dividends, this type of model will not work very well. So let's think about a preferred stock. Preferred stock pays a dividend of $6. The required return's 12%. So in our stock valuation dividend model worksheet, we can plug our numbers in, right? Yellow boxes. $6 is D0. That's the beginning dividend for the stock. The K sub S here, or the R sub S, excuse me, is the required return on the stock. That's 12%. And D1 is $6, right? It's a preferred stock. It has 0 growth. So this stock is worth $50. If I told you that this stock was selling for $47, would you purchase this stock? Would you pay $47 to get $50? Of course you would. If you actually paid $47, you would earn 12.7%, and you required 12%. So this would be a good investment based on the information provided by this dividend growth model. There are some times where you may be given what you think next year's dividend is going to be, or you will forecast what you think next year's dividend will be. If you know what D1 is, or if you have a prediction of what D1 will be, you can plug it in this box down here, and of course it shows up under D1 here. Now with this model, the only challenges with this worksheet is that that number doesn't disappear when you turn the spreadsheet off. So you always want to make sure you delete this from this box so that it doesn't cloud the example over here. But if it's historically it's grown at 9%, required return for the stock is 17%. Again, here the stock value is $43. Stock price is $47. It costs more than what it's worth, so this is not a good investment. The way it works a little bit easier, I guess, or more frequently, is The most recent dividend, you know what you just got paid was $2.65, so that goes in for D0. Dividends have historically grown at 5%, required returns 20. This stock has a value of $18.55, and its current stock price is 20. Again, you wouldn't spend 20 to get 18, so this particular investment is a bad investment. You would not want to purchase this stock. Now, one of the things we have to incorporate in this is the idea of growth, right? How are the dividends going to grow? We can look at historical information, right? We can look at the company's annual reports. We can assume the growth will continue maybe at or near that average, or we can even give it a little bit of a growth over time, right? But we need to understand something about how dividends ultimately are determined. Where do they actually come from? So one of the ways we can look at this is what's recalled as the retention rate formula. So the retention rate for the stock is 1 minus dividends per share divided by earnings per share. This is the percentage of earnings that have been retained in the company. So let's think about, what does a company do with this retained profits? It takes those profits and reinvests it. What rate of return does the company get on money that's invested by shareholders? That's a ratio called return on equity. So the growth of the company moving forward is return on equity multiplied by this retention rate ratio. Now, as long as the company doesn't change its dividend payout ratio, the growth rate here of this earnings will also duplicate itself in the growth rate of dividends. So unless we change our dividend policy, this is a good forecast of what we think dividends should be in the future. Now again, real data can give us some very strange numbers. So we always want to temper this with an idea of, well, what's realistic? What's more likely to be true? One of the things we can look at is looking at historical dividends. So what has it just been in the past? And of course, we can use this stock valuation dividend model worksheet if you just plug in the data. The beginning dividend was $1, went to $1.50. It took 5 years, right? 2015 minus 2010. It took 5 years for that growth to happen. And in this case, it was $6 and 6.96% is the growth of this company's dividends. If we look at the retention ratio formula, the dividend payout ratio for this company was 40%, and their return on equity averaged 12.5%. So the growth rate from this retention model was about 7.5%. So again, somewhere between 6.96, essentially 7, and 7.5% is what you would expect the growth rate to be. So maybe you'd use the average of the two. And again, I would just remind you, right, that you do have to use some common sense. This earnings growth rate model can sometimes provide some very strange numbers, right? If the company has been, the return on equity is extremely high, it's quite possible that this growth rate could just be, it could maybe just not make sense. So again, you have to adjust your information, if you will, or your prediction based on the things that you know to be true or most likely about the company. So that's the end of the second video on stock valuation.